Yesterday morning at 8:30 a.m., the government released the most anticipated inflation report in years. The headline number hit 3.3%, the highest annual inflation rate since April 2024. Energy costs surged 10.9% in a single month. Real wages fell 0.6%. Every financial news channel led with the same story: inflation is back and it is bad. But buried 4 paragraphs into the same government report was a completely different number that most people know. It reached core inflation, the measure that strips out the oil war spike and shows what is actually happening to everyday prices, came in at just 2.6%. Below forecast, below the previous month, and with several categories actually showing outright price decreases. The same report. 2 completely opposite stories. And the story you heard depended entirely on which number you saw first. In the next 13 minutes, I am going to show you both numbers, explain exactly what each one means for your mortgage, your savings account, your investments, and your grocery bill, and give you the complete action plan for your money based on what the full report actually says rather than what the headline told you. Stay until step 7. It involves a specific calendar date in May that could be the most important single day for your personal finances in the next 60 days, and almost nobody is talking about it yet. The March 2026 Consumer Price Index report landed Friday morning with 2 entirely different stories inside it. The CPI increased 0.9% in March on a seasonally adjusted basis, putting the annual inflation rate at 3.3%, pushed by a 10.9% surge in energy costs. Both numbers were in line with consensus forecasts. The annual rate was the highest since April 2024 and up from 2.4% in February. That is the story that dominated every financial headline. Inflation is back, it is bad. The Fed cannot cut rates, but excluding food and energy, core prices rose just 0.2% for the month and 2.6% from a year ago, both 0.1 percentage point below forecast. There were even pockets of outright price declines. Medical care, personal care, and used cars and trucks all fell during the month. 2 numbers, 2 stories, and the story you choose to focus on determines every financial decision you make in response to this report. I am the Silent Shift. In the next 13 minutes, I am going to walk through both stories completely, explain what drove the 3.3% headline, what the 2.6% core number reveals about the underlying economy, what the ceasefire means for where inflation goes from here, and give you the complete 7-step plan for your money. Stay until step 7. It is the most time-sensitive financial action available to you in the next 60 days. Let me start with the headline number because understanding exactly what caused it is essential for understanding why it may not be as permanent as it looks. The 3.3% annual CPI reading was driven almost entirely by one thing: energy. Energy costs surged 10.9% in March alone. Gasoline added more than half a percentage point to the total monthly reading by itself. Transportation costs, utility bills, and manufacturing input costs all rose in response to oil hitting over $111 per barrel during the height of the Iran war. This is what economists call a supply shock inflation. It is different from the demand-driven inflation of 2021 and 2022 in a critically important way. Demand-driven inflation, where too much money is chasing too few goods, requires the Fed to raise interest rates to cool spending. Supply shock inflation, where a specific external event artificially restricts supply, tends to reverse when the supply disruption resolves. The Iran war closed the Strait of Hormuz. That is the supply disruption. The ceasefire this week is beginning to resolve it. Oil has already fallen from $111 to under $95. The supply shock that created March's 3.3% reading is actively reversing in real time. Traders showed little initial reaction to the report, with stock market futures slightly higher and Treasury yields mixed. Goldman Sachs Asset Management said the Fed will look through the energy-driven noise so long as ceasefire conditions hold. The 3.3% headline is real. It accurately captured what happened to prices in March. But it is a rear-view mirror reading of an energy shock that has already begun to reverse. The question for your financial decisions is not what happened in March, it is what happens in April and May. And the data available right now strongly suggests the answer is better. Now let me explain why the 2.6% core number is arguably the most important thing in the entire report, and why almost nobody is talking about it. Core CPI measures inflation in the things that are not subject to volatile daily price swings driven by wars and weather. It measures rent, medical care, haircuts, restaurant meals, clothing, education, recreation, the things that make up most of the daily economic experience of ordinary Americans. And core CPI came in at 2.6%, below the 2.7% forecast and below the 2.8% reading from February. This tells us something critically important. The underlying inflation trend in the U.S. economy is actually improving. Prices for core goods and services are rising at a slower rate now than they were in December, January, and February. The structural inflation problem that the Fed has been fighting for 4 years is making progress. The dramatic 3.3% headline was not evidence that this structural progress reversed. It was evidence that an oil war temporarily overwhelmed the underlying trend. And now that the oil war has a ceasefire, the underlying trend reasserts itself. Following the release, the probability of a June rate cut fell from about 55% to 35%. The sticky core inflation suggests the Fed will need more convincing data before acting, but here is the nuance that the 35% probability does not communicate clearly. The question is not whether the Fed cuts in June. The question is whether the trajectory of inflation over the next 60 days supports a cut in September or December. And the core number -2.6% and falling, combined with a ceasefire that is reversing the energy spike, makes that trajectory look more positive than the headline suggests. Real average hourly earnings for the 12-month period increased 0.3%. That is thin. Wages are barely outpacing inflation over the full year. But it is positive rather than negative. The consumer is squeezed, not destroyed. Let's get very specific about the mortgage rate implications. This is the financial decision most affected by the CPI report. Mortgage rates are directly influenced by the 10-year Treasury yield. The 10-year yield is influenced by inflation expectations and Federal Reserve policy. When inflation is high and rising, the 10-year yield rises, and mortgage rates follow. When inflation falls and the Fed is expected to cut, yields and rates fall. The 30-year fixed mortgage rate currently sits around 6.5%. Before the Iran war, it was trending towards 6%. Before the rate hike cycle of 2022, it was near 3%. Here is the path forward based on Friday's CPI data. The core inflation reading of 2.6%, below forecast, is mildly positive. It suggests the Fed does not need to raise rates and may still cut later this year. The ceasefire means April's oil prices will be lower than March's. Lower oil prices mean lower energy inflation in the April CPI report. A cool April CPI on May 12 would significantly boost rate cut expectations. Rising rate cut expectations would push mortgage rates lower. The window for mortgage refinancing may be opening in late Q2 or Q3 2026. Not because of any single data point, but the trajectory Friday's report revealed. What you should do right now is get your refinancing paperwork prepared, check your credit score, gather income documentation, get a current home appraisal. When the window opens, prepared people will capture lower rates. Before demand surges and lenders get backed up, there is a relationship between oil prices and CPI readings. It has been remarkably consistent for decades. Oil prices today predict inflation readings approximately 4 to 6 weeks from now. Oil affects transportation, manufacturing, utility bills, and food prices. What happens to oil now shows up in the CPI later. In March, oil averaged over $100 per barrel for most of the month. The March CPI came in at 3.3% annual inflation with a 10.9% energy surge. Exactly consistent with the historical oil to CPI relationship. Now look at where oil is today. Oil fell nearly 16% to under $95 per barrel after the ceasefire. If oil averages around $90 to $95 through April, the April CPI report on May 12 will show energy costs rising significantly less. The most likely scenario is energy costs in April rising perhaps to 4%. That would pull the headline CPI reading back below 3% significantly. The next critical release is the Personal Consumption Expenditures Price Index. This is the Fed's preferred inflation gauge and often runs slightly cooler than CPI. Then the April CPI on May 12th. These two data points will tell the complete story of whether March was a spike or a shift. The oil chart is already telling you the likely answer. March was a spike. And the spike is already reversing. Here are 7 specific moves based on what the complete CPI report tells us. Ranked by urgency. Step 1. Use the Saturday weekend to update your emergency fund situation. High-yield savings accounts are currently paying around 4% AP. The rate cut that might eventually bring these yields down has been pushed further. The probability of a June rate cut fell from 55% to 35%. That means 4% AP savings rates are staying for at least several more months. If you have money sitting in a traditional bank account earning 0.5% or less, move it today. The difference on a $25,000 emergency fund is $875 per year. Step 2. Begin preparing your mortgage refinancing documentation now. The trajectory points toward a potential refinancing window opening in late Q2 or Q3. Prepare now. Gather your last 2 years of tax returns. Get a recent pay stub. Check your credit score. Identify your current mortgage balance and rate. When the window opens, you will be ready to act within days instead of weeks. Step 3. Negotiate your raise using today's real data. Real average hourly earnings fell 0.6% in March. If you are due for a salary review, come prepared with the actual inflation data. You need a minimum 3.3% raise just to maintain your purchasing power. Present this as a factual data-driven request, not an emotional one. The CPI report is public government data. Using it is professional and legitimate. Step 4. Do not panic out of equities based on the headline number. Traders showed little initial reaction, with stock market futures slightly higher. The market read the same full report you now understand. Core inflation below forecast means the structural inflation problem is not getting worse. The headline spike was energy-driven and already reversing. Long-term equity investors have no reason to change strategy. Step 5. Mark May 12th on your calendar in red. The April CPI release date is the next major financial pivot point. April's reading should show meaningfully lower energy inflation than March's. If that happens, rate cut expectations surge, bond yields fall, mortgage rates decline, and the stock market rally gets a second wind. May 12 determines whether the second half of 2026 is recovery or uncertainty. Step 6. Consider your food and grocery purchasing strategy. While medical care, personal care, and used cars fell in March, food prices remain elevated. The best approach is strategic bulk purchasing of non-perishable items. You are essentially buying ahead of the disinflation that is coming. Step 7. Build one new financial habit this weekend. The most financially resilient people build consistent automatic habits. 1 automatic monthly investment, 1 high-yield savings account, 1 401k contribution increase, 1 subscription canceled and redirected to investing. Pick one. This weekend, set it up automatically, then stop thinking about it. That habit, repeated consistently, builds real wealth over a decade. The March CPI report showed 3.3% annual inflation. That is the headline. But the same report showed core inflation at 2.6%, below forecast. Medical care, personal care, and used car prices actually declining. The market barely moved. Goldman Sachs said the Fed will look through the spike. And oil has already fallen 16% from its peak as the ceasefire holds. The headline told one story. The full report tells a different one. The difference is between making good financial decisions and emotional ones. You now have both stories. You have the 7 steps to act on them. And you have May 12th circled as the next major financial pivot point. That is the information that matters, not the number that scared you. Subscribe to the Silent Shift for daily finance moves that read the whole report, not just the headline that everyone panicked about. The shift is quiet, but the data is clear.